Hey there fellow traders, in today's video we'll be diving into the fascinating world of candlestick charts. In this session we'll talk about how to read candlestick charts, we will cover the introduction to candlestick charts, the anatomy of candlestick, different types of bullish and bearish candlestick patterns including candlestick charts, and we'll also explore few real-life examples. If you are a beginner trader, by the end of this video, you will have a solid understanding of candlestick charts and will be well equipped to analyze price movements and make profitable trades. If this interests you and you'd like to receive more educational content like this, don't forget to click the subscribe button below. So let's get started. What exactly are candlestick charts? Candlestick charts are a visual representation of price movements over time. They provide valuable information about the open, close, high and low price of an asset over a specific time period. Each candlestick tells a story about the battle between buyers and sellers. For example, green candlesticks are bullish. Green candlesticks are formed when the closing price is higher than the opening price. A green candlestick indicates a price increase. Green candlesticks are typically associated with buying an asset. On the other hand, red candlesticks are bearish. If the closing price is lower than the opening price, the body is usually colored red, representing a bearish sentiment. A red candlestick indicates a price decrease. Red candlesticks are typically associated with selling an asset. A candlestick consists of several components that provide valuable information about price movements. This rectangular part is called the body and represents the price range between the opening and closing prices. Now, during a specific time, the body can be filled, colored, or empty depending on whether the closing price is higher, lower, or the same as the opening price. As previously stated, when the closing price is higher than the opening price, the body is typically filled or colored green as the first candlestick, indicating a bullish or positive sentiment. However, when the closing price is lower than the opening price, the body is usually empty, often red, representing a bearish or negative sentiment. These lines that extend from the body are called wicks or shadows. The upper wick or the upper shadow extends from the top of the body and represents the highest price reached during the time period. The lower shadow or the lower wick extends from the bottom of the body and represents the lowest price reached during the time period. By analyzing the combination of body size, shadows, and positioning, you can derive valuable insights into market direction and price action. For example, a large bullish candlestick with a small or no shadow suggests strong buying pressure. Conversely, a large bearish candlestick with a small or no shadow indicates significant selling pressure. When you look at these candlesticks called doji, for example, you realize that the open and close prices are almost the same. The doji has a little body and its upper and lower shadows are very long. Doji candlesticks represent market indecision. Now that you've understood the components of a candlestick, let's look at how to read a real candlestick chart. Your first step should be to identify the time frame, determine which time frame you want to use. It can be minutes, hours, days, weeks, or months, depending on the chart settings and the duration you are analyzing. Each candlestick on the chart represents the open, high, low, and close prices for a particular period. The body of the candlestick shows the price range between the open and close, while the upper and lower wicks or shadows represent the high and low prices reached within the interval. In trading, a 1-minute time frame means that each candlestick or bar on the chart represents the price movement over a 1-minute interval. A 15-minute time frame means that each candlestick or bar on the chart represents the price movement over a 15-minute interval. Similarly, a 1-day time frame means that each candlestick or bar on the chart represents the price movement over 1 day. Let's use a 1-minute time frame for example. When you look at this red candlestick on our 1 minute chart, the vertical line represents the time of the formation of the candlestick. You can see that the candlestick opened at 1.233309 and closed at 1.23297. The candlestick was created at 1803 on the 25th of May. Each candlestick forms in 1 minute. Now zoom out your chart and consider the broader context of the chart. Look for trends, support and resistance levels, and overall market direction. Analyze the sequence of candlesticks and identify the overall trend in the market. Look for patterns of higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. Consider support and resistance levels and the prevailing market sentiment. Looking at our chart, it contains lower lows and lower highs, which typically refers to a downtrend pattern. A lower low occurs when the price of an asset reaches a new low point that is lower than the previous low. This indicates that the sellers are pushing the price lower and that bearish momentum is prevailing. A lower high happens when the price of an asset reaches a peak that is lower than the previous high. It suggests that the buyers are unable to push the price higher and bearish pressure is still present. When a series of lower lows and lower highs are consistently formed, it indicates a downward trend in the price. This pattern suggests that sellers are in control and there is lack of buying interest. To reverse the trend, use additional technical indicators. Incorporate other technical indicators such as moving averages, trend lines, volume or oscillators for further confirmation of the market trends and potential price movement. Now that you are well informed, it's time to look for an entry point. Look for patterns such as breakouts, trend reversals, or support and resistance levels that suggest a favorable entry. Use bullish and bearish candlesticks pattern to identify potential entry points. Some of the commonly used patterns include bullish engulfing. The bullish engulfing pattern is a candlestick pattern that often indicates a potential reversal of a downtrend and suggests a bullish move in the market. It consists of two candles, a small bearish candle followed by a longer bullish candle that completely engulfs the previous candle. As you can see here, the first candle is a smaller bearish candle indicating a continuation of the current downtrend. It shows that the sellers are still in control of the market. The second candle is a larger bullish candle that opens lower than the previous candle's close, but closes higher than the previous candle's open. The bullish candle engulfs the entire range body and shadows of the bearish candle. This indicates a reversal in the market from bearish to bullish. The bullish engulfing pattern suggests that buyers have gained control and are overpowering the sellers, potentially leading to a trend reversal or a significant upward move in the price. Traders often interpret this pattern as a signal to enter long positions or buy the asset. The second candlestick pattern to look for as a potential buy signal is the Morningstar candlestick pattern. The Morningstar pattern is a bullish reversal pattern that consists of a series of 3 consecutive candlesticks that indicate a potential shift in the market direction from bearish to bullish. As you can see here, the pattern begins with a long bearish candlestick indicating a downtrend. The second candlestick is a smaller candlestick that has a narrow range indicating indecision and a potential weakening of the bearish momentum. This candlestick can be either bullish or bearish. The third candlestick is a bullish candlestick that closes above the midpoint of the first candlestick. It represents a reversal in the market direction, with buyers gaining control and potentially reversing the previous downtrend. A morning pattern suggests that after a period of selling pressure, a bullish reversal is likely to occur. It signifies transition from bearishness to bullishness, indicating a potential buying opportunity for traders for bearish candlestick patterns. The shooting star is a popular candlestick pattern that signals a potential trend reversal. It is considered a bearish reversal pattern and typically appears at the end of a trend. The shooting star pattern is characterized by a single candlestick with a small body and a long upper shadow or wick. The shooting star pattern can be either bullish or bearish depending on its position within the broader price action. The body of the candlestick is usually the low of the day, while the upper shadow extends well above the body, representing the rejection of higher prices by the bears. The body of the candlestick should be small and near the low of the day. It represents a small range between the opening and closing prices. The long upper shadow or wick should be significantly longer than the body. It indicates that the price rose sharply during the trading session but was rejected and pulled back. Ideally, there should be little to no lower shadow, or it should be relatively small compared to the upper shadow. Another bearish candlestick pattern is the bearish haram. A bearish haram is a candlestick pattern that indicates a potential reversal in an uptrend. It is formed by two candlesticks, where the first candlestick is a large bullish candle followed by a smaller bearish candle. As you can see here, the first candlestick is a large bullish candle indicating buying pressure and an ongoing uptrend. This second candlestick is a smaller and bearish, meaning that the price opened higher than the previous close, but closed lower. The body of the second candlestick should be entirely within the range of the first candlestick. The bearish haram suggests that the buying pressure from the previous trend is weakening, and there is a possibility of a trend reversal or a showdown in the upward momentum. It indicates indecision in the market, with the bear starting to gain control over the bulls. Traders often interpret the bearish haram as a signal to potentially consider short positions. Thank you for watching. If you're interested in taking your Forex trading skills to the next level, we have a comprehensive training course that can help you achieve your goals. Click on the subscription box below to visit our website and gain access to our exclusive course materials, expert strategies, and practical insights. Don't miss out on this opportunity to enhance your trading knowledge and boost your profitability. Go check out the course now and let's embark on this exciting journey together. See you in the next one. Bye-bye.